Do not trust here. So car loans are a trap. In this video, I'm going to break down why a car loan is a trap, why are high interest car title and payday loans especially dangerous, and psychological tricks dealers use to push you into costly car loans. So let's get into that. Hit that subscribe button though. Hit that subscribe button. Basically, a car loan can be considered a trap for several key reasons related to its cost, structure, depreciation, and dealer financing tactics. So high interest costs and long terms, right? So car loans often come with high interest rates like around 7 to 12% APR and long repayment periods of up to 72 or 84 months. So this means that over the life of the loan, you can end up paying significantly more than the car's original price. For example, a $45,000 loan on a BMW with a 7.5% APR over 6 years can total over $56,000, and extending the term to lower monthly payments can increase total cost to nearly $63,000. There is negative equity and depreciation, so rolling over debt into new loans. When trading in a car with negative equity, dealerships often roll over the unpaid balance into a new loan for your next vehicle. This means you start your new loan already owing more than the car is worth, increasing your debt burden and making it even harder to escape the cycle. There's long-term financial stress, so carrying negative equity basically reduces your purchasing power and limits your financial options. So if you need to sell or trade in your car, you must pay the difference out of pocket or add it to a new loan, perpetuating debt and increasing your monthly payments and total interest paid. There's slow equity buildup, so long-term loans and small or no down payments mean your loan balances decreases slowly while your car's value drops quickly due to depreciation. This keeps you underwater for much of your the loan term, making it difficult to reach positive equity. There's limited mobility, so negative equity can trap you in your current vehicle even if your needs change or you experience financial hardship. So selling or trading in the car often requires paying thousands of dollars just to break even, which many buyers cannot afford. So there's increased interest costs. So when negative equity is rolled into a new loan, you pay interest not only on the new car, but also on the old debt, compounding your financial losses over time. Now, here are the dealer financing tricks, right? Car dealers use a range of psychological tricks to push buyers into costly loans by manipulating emotions, creating urgency, and obscuring the true cost of the deal. Now, here are the most common ones, right? We're going to start with emotional manipulation and sense of ownership. So dealers encourage test drives and personalize the experience, adjust the seat, turn on your favorite music to foster a sense of ownership and excitement, making it basically harder for you to walk away. There's time pressure and scarcity. So salespeople often claim that a deal is only available today or that another buyer is interested, creating a false sense of urgency and scarcity to pressure quick decisions. There's focus on monthly payments, not total costs. So, basically stretch the loan term, right? They can lower your monthly payment by extending the loan over more years, which increases the total interest you pay and the overall cost of the car. It's kind of like bait and switch. There's hide profit centers, so focusing on monthly payments lets dealers manipulate other variables such as the vehicle price, interest rate, trade-in value, and add-ons without the buyer noticing, since the monthly payment can be kept artificially low even as these costs rise. They can make the deal seem affordable, so a low monthly payment feels more manageable to buyers, making them less likely to question the total amount they will pay over the life of the loan. See how they get you? There's the confusion of and wear of down buyers. So dealers use complex negotiating tactics, right? Like the 4-square method, basically to keep buyers focused on the monthly payment, making it harder for them to track the real cost and easier for the dealer to basically add hidden fees or upsell extras. The 4-square and payment-only negotiation, so dealers use negotiation worksheets like the 4-square method to juggle, numbers, trade-in value, down, payment, monthly payment, and purchase, price. So you focus on one variable at a time, making it easier for them to hide, unfavorable terms elsewhere in the deal. There's the bait and switch. Here's another kind of version of that, where advertised deals often disappear when you arrive, replaced by more expensive cars or loans with higher rates. Dealers also may offer a loan at one rate, then claim you don't qualify and push you into a higher rate loan after you've committed. There's yo-yo financing. So after you drive off, the dealer might call back claiming your financing fell through and pressure you to accept a worse loan, knowing you've already traded in your old car or invested emotionally in the new one. There's reciprocity and small gifts. So offering free snacks, coffee, or small perks creates a subconscious sense of obligation, making customers more likely to agree to the dealer's terms. There's the Ben Franklin clause. So the salesperson lists the pros and cons on paper, to make it seem logical to buy, but the list is often biased to sway your decision. There's psychological profiling and reading cues. So dealers, they basically watch your reactions and tailor their approach based on your personality and responses to minimize their leverage. There's predatory lending and loan failure design. So some auto loans, especially those targeted at subprime borrowers, are structured with high interest rates and fees that make them difficult to repay. So this can lead to repeated defaults and repossessions, further demanding credit and financial stability. Such loans are sometimes designed to fail, profiting lenders through fees and repossessions. Now, there are some additional costs. We have, besides interest, buyers face insurance, taxes, and maintenance costs that add to the financial burden, making the overall cost of car ownership much higher than just the loan payments. There's, now let's get into high interest car title and payday loans. They are very dangerous because of these interrelated factors, that basically trap borrowers in cycles of debt and lead to severe financial consequences. So exorbitant, interest rates, both payday loans and car title loans often carry annual percentage rates, APRs, well above 200%, with some reaching 300% or even higher. This means borrowers can end up paying more in interest and fees than the original loan amount, making repayment extremely difficult. There are short repayment periods, so these loans typically require repayment within a very short time frame, often just a few weeks or a month. So if borrowers cannot repay in full, they must roll over the loan, incurring additional fees and interest, which quickly escalates the total debt. There's the cycle of debt. So the structure of these loans is designed so that many borrowers cannot repay them on time. Most end up renewing or extending the loan multiple times, each time accruing more fees and interest. For car title loans, studies show over 80% of borrowers renew their loans at least once, and many do so multiple times. So that's what I have for you today. Please take a moment right now to hit that subscribe button and the like button. If you want more videos like this, if you appreciate this content, let me know that right now by hitting that subscribe button and that like button. Also hit that notification bell so you are alerted when I upload new videos. Also let me know your comments in the comment section. I appreciate your viewership. Stay safe and see you on the next video.